Another bank failure and the market goes higher. The Fed raises their interest rates and the market goes higher. More bad news comes out about GDP and recessions and the market goes higher. What to make of all this? Have the rules changed? And if they have, what are the new rules? Stick around. I'm going to talk about all that and more. Hey everybody, RC Peck here with Fearless Wealth, and this is my weekly video. There is a lot going on this week. Oh my gosh, more banks failing, and it doesn't seem like the market even cares. Oil is falling, and it doesn't seem like the market really cares. Iconic people are getting their net worth literally almost cut in half, and no one seems to care. So what I want to do is go over what's going on. I'm going to look at three specific parts of the market and maybe with a bonus. So let's do that. Let me get over to the charts. And we're going to start with this chart right here. It's US corporate spread. So let me just tell you what we're looking at here. Do you get paid more to give your money to the US government? Let's call that the free rate of return. Or do you get paid more to loan your money to a corporation? Now, here's the thing. You should get paid more if you loan your money to a corporation because that is riskier and they should pay you more. As you look at this chart, when it goes lower, that means, this is kind of crazy, but that means you actually get paid more money when you give your money to the federal government. Now, the last time, first of all, this chart goes back to 1991. So let's just call it easy math, 30 years. It's never been inverted in the last 30 years. It's inverted now. That's insane. The last time we were close to this was the 06-07 time period. Now, the market actually peaked in October of 07. So typically what happens is after these type of spreads, whether it's a 10-year minus a 3-year yield, the 10-3, or it's one of these corporate spreads, the market typically historically starts to tank the stock market when these spreads start going up. But I just want to show you this because it was so inverted, and it's one that very few people look at. It's just basically saying, wow, no one's getting paid to own anything but treasuries. So here's a price chart of the treasuries right here. It's the yield of the 3-month treasury. It's a pretty big chart. It's 17 and a half years in range. And I wanted to have this 17 and a half years because I wanted to just show you the last time the yield on the 3-month treasury was this high was something called 2007. And if you're watching this and not just listening to it, after the beginning of 2007, the yield on the 3-month went from 5.25 down to 0 in a significantly short amount of time. We'll call it 24 months, which is pretty amazing. And during that same time period, we had the global financial crisis. So the yield on the 3-month is up here now. I don't think it's going any higher. I don't think the Fed, I've talked about this for many months, the Fed's going to raise rates to 5%, maybe 5.25. So they did, they raised to 5.25. That's the upper end of the range. And we're right back to pre-08, or we're right back to the beginning parts of 07. So that's typically not a good period of time. Now, going into 06, 07, and this is a point I want to make, and actually let me just come back to here. So this is a point I want to make. 06, 07, people were warning us about housing. People were starting to short the housing market, and they were wrong for like a year. Like literally, they were right about what was going on. They were just about a year early. It could be that this time there's a lot going on. Right back in 08, Bear Stearns failed in March, and then Lehman Brothers failed in September, and then the market bottomed in March the following year. So the market takes time to digest what is going on. And so that is what I see going on here. But yes, we have a yield. And if you want to get a 3-month treasury, now might be the time to do it. Though this video is not about giving individual advice, but man, oh man, 2007. It's actually a little bit above 2007. Okay, the next thing I want to show you, the second piece of data I want to show you is just what it looks like is happening right now. We have 3 bank failures in the last 6 weeks. First Republic, Silicon Valley Bank, and Signature Bank. Now, just 3. So a lot of people hear, oh, it's only 3. But what I love about this price chart, it shows you in how much of the deposits were in each one of those 3 banks, and it compares it to the deposits of the 2008 through, let's just call it 2012, 150 banks failing, right? The loss in deposits is above, for sure, the '08. And so even though it's only been 3 banks, first of all, there's fewer banks today than there were 15 years ago. These are big banks that are failing. You can see it visually. So when you see it visually, it really helps rather just hearing like, it's 3 banks, deposit numbers. I mean, sometimes I say billion when I mean million, or million when I mean billion, or trillion and not million or billion. I'm like, our brain doesn't understand big numbers, but being able to see what is going on is like, wow, something is wrong. Something is wrong. And that's what I really wanted to show you here in this specific chart. Now, it shows up here. Now, this is KRE. This is the S&P Regional Banking ETF. It's down 53% from the beginning of 22. Easy math, what is that, about 16 months? This is not good. Now, I don't want to just keep coming back to this chart each week and be like, it's still bad. But it is still bad, and it's getting worse. And it's below its pre-COVID high, which I've talked about a lot. And I think it's going to its COVID low, because that's where it wants to go to test price. Now, it's at $36 as I record this. I'm closing this close of market on Thursday. Yeah, maybe it could only fall to $32. And if it did, that would only be a 58% fall. But I think it's very likely, as this thing gets moving, it could retest its COVID low. And that is not a good thing. And just really quickly, let's just kind of jump around the world of regional banks. Here's PacWest, clearly going out of business. This is incredible. For reference, everyone, here is its, come on. Here's its pre-COVID high. Here's its COVID low. It was consolidating below its COVID low. And now it's just dropping like 50% a day. That's not good. But look, it's a small bank, and clearly the market doesn't care about small banks. We're learning that very quickly. Here's Zion. The reason I bring up Zion is because there's a lot of insider buying by directors and people in the know. Even though they're buying, you can't go against sentiment. You can't go against the market. This is below its pre-COVID low. So banks with insider buying, okay, from director and above employees, they are breaking below COVID low. That's not good. Here's one more too. Man, California banks, again, below COVID low. This is Western Alliance. Just on Thursday today, it was down 38%, and it's below its COVID low. I'll leave you with one more bank, and I think it's actually probably one of the more important banks. It is U.S. Bank Corp. I talked about it, 2 weeks ago? This is the 5th largest bank in the United States, 5th. So it's number 5. It's not 15 or 35. It's not 4 billion. It's 44 billion. It's not falling like the little guys, but from its peak to where it closed today is down 52%. And it is absolutely, I shouldn't say absolute, there's not many absolutes, but man, it looks like it's going to test its pre-COVID low. So banking has not, the banking sector, certainly the smaller banking sector, and this is the 5th biggest bank in the US based on deposits, so it's, let's just call it the banking sector, is weakening. Okay, that was number 2 that I wanted to show you. Here's the 3rd thing. In periods of instability, okay, so I really want you to get this. In periods of instability, crazy things happen. So there's a company, Hindenburg Research, and they are short sellers, and they're going after Carl Icahn's company called Icahn Enterprises, original name. Now, it used to be a $15 billion market cap stock. Today, it's a $10 billion market cap stock. Carl Icahn is literally an icon of the investment world. He used to be the 58th richest person on the planet. Not anymore. He's the 119th richest and falling, or getting, maybe he'll be the 200th richest soon. But I just want you to see this, right? This is an icon of investing, and it is literally getting taken out. 85% of Carl Icahn's net worth is in this black squiggly line. This is what we see in periods of instability, right? When the tide goes out, we see who's naked. And I don't think this is regional banks that we're looking at right here. Doesn't look like it. So it's kind of spreading. Okay, then lastly, what I wanted to show you was this number. So this is the national debt, and I want to pay close attention to 2011, where the national debt was about 15 trillion. I literally had to think about that. $15 trillion today. It's a little over 30 trillion. Now there's a debt ceiling debate going on. So what I just wanted to simply show you was, here is the last time we had a debate. Let me just go up here. So back in 2011, there was a debate between the two sides, the two political parties in the United States, whether they should raise the debt ceiling or not. It's been raised 79 times over the last 63 years. So first of all, it's going to get raised. But what, will one side scare the other side or scare the market, where this right here, the market fell about 18%, being pretty scared that bad things were going to happen. I don't see that happening this time, but I just want to show you the last time we had kind of this polarizing, we're not going to do anything point of view. And so we're left with, there are periods of uncertainty, and we're in one of those periods. They're about 12% of the time. 88% of the time, the market just kind of goes higher in a nice, smooth up, moving trend. That's not this. Right now, we're in a sideways trend, and we have a lot of information hitting the market, and the market's having to digest it. I wanted to throw in the Carl Icahn chart because it's not just staying in one place. And yet on the other side, you have these massive, massive companies, whether it's JP Morgan going up or Microsoft going up, right? The biggest are getting bigger, right? And the smaller ones are not being protected. So the net is we will watch the price charts. We will watch the market. We'll watch the stock market. I will watch the stock market, the bond market, the commodity market, the gold market. Those markets matter because historically that is telling us how people are voting. So the takeaway, more uncertainty. Yes, a Microsoft or a tech company does well or doesn't do well, but we're seeing a lot more instability, and still the market just kind of goes sideways. So that's what we have right now. We have to invest in the market we have. I would not be doing any back up the truck investments. This is really one where you want to be kind of have a more cautious stand, which doesn't mean all cash. It just means cautious. Thanks for being in my world. I appreciate you watching these videos, liking, subscribing, commenting, all the things that the YouTube algorithm likes. Thank you for doing that and continuing to do that because it makes a difference. After all, this video is free. If you think I got something right or wrong, leave a comment. Tell me what you think. I appreciate all comments, especially the ones that have no hate in them. Even if you think I'm wrong, totally fine. And if you find yourself curious or wanting to know what it would look like if you had a portfolio with downside protection, which is how I manage my clients' money. Downside protection, no annuities, no whole life insurance policies, literally a way to protect your downside, because here's the game you gotta win. You can't go from $1 million to $500,000, right? Losing half your money is very expensive, given that that means you have to grow that money by 100% just to get back to break even. And the average annual growth is 10% a year for the S&P. That means at a minimum, you're looking at historically about 10 years just to get back to break even. So what we're talking about is saving time. It's like a time machine, right? You'd rather only lose 20% instead of losing 50%. So if you want to look and see what that downside protection would look like for you, go into the description and get on our calendar, and we can have a 15-minute conversation to see if there might be or where there might be a fit. Thanks, everyone. Have a good weekend. Okay, bye.